when you look at how the allocators are deploying capital, this reminds me of some of the challenges this year that small businesses or VC firms have when you have a high interest rate environment where there's going to be some problems with funding, and funding rates are very, very high right now. It also increases the hurdle rate for acquisition targets. How are you looking at these companies today? And I guess, this is a two-pronged question, is how are you evaluating these allocators today, which we haven't been in a QT environment in quite some time. And so would the model still work in this environment today as it has in the last 4, 5, 6 years? And then the second question, I'll follow with up afterwards.
Well, actually, when we looked at the last 5 or 6 years, it was really, we were struggling. I mean, we were producing good returns. We were trying to stay with the markets, but low interest rates are actually a bigger drag on our model than higher interest rates, because low interest rates brings in higher valuation. You get private equity just moving everything in every sort of direction. And our companies don't compete directly with private equity, but the evaluations that private equity tends to put on things and the private markets was elevated. And so, lower interest rates really affected us that way. As interest rates have moved higher, most of our CEOs and companies have expanded and gotten ready for M&A again, because they're seeing some of the best environments they've seen. Remember, because they are all cash buyers and they're not looking to borrow, and their cost of capital is much lower than other people. So this, and one CEO we spoke to a few weeks ago said that it's the best environment he's seen since 2008, which goes back to your comment. We may not be seeing the struggle in small and medium-sized businesses in the public markets yet, but we are hearing about it in the private markets already, because our acquirers are seeing lower valuations and more businesses for sale.
When you step back and you look at this runway of fantastic opportunities, knowing that your CEOs are getting ready to deploy cash, which in a high interest rate environment, they're immune to, does this also instruct how you retain dry powder in the fund?
Yeah. So what we'd always like to do is, when you get involved in a company, you have to know that you're going to go through a cycle with it. A cycle with an acquirer is a period where they don't acquire. Mm-hmm. So over the last few years, acquisition has been lower, cash has been building. And for a company in the public markets, especially with low interest rates, that tends to discount their price. So our multiple, even though our earnings per share in our portfolio and within our companies has grown higher, our multiple has contracted a little bit. So as I say, we stayed with the markets for the most part, but we didn't exceed them as much as we thought. This strategy should well exceed the markets over the long term, and we believe it will. But in a low interest rate environment, we found that because of the cash buildup, the multiple on some of our companies was lower, but that is now changing. And so they are able to put more money to work, and that should start getting the attention of people. People almost give up on them. You need to have a long-term outlook. There's no way you can go through a cycle without doing it. So we make an acquisition. We think this has to go through a cycle. Did we price it right when we made the acquisition? Did we price it right if he goes on hold or she goes on hold? And that's how we look at their cycle. And it's almost counter-cyclical in a number of ways, the acquisition type approach, because when markets are coming off and valuations are going lower, our companies are the most active.
Let's take a slice of industries now, right? You have different industries that do particularly well. Surely your team must be excited about certain pockets of where the economy is, where the markets are. We just came out of a surprise boom in the AI and tech sector coming out of the first quarter with AI and ChatGPT. Naturally, nobody could have predicted this, but it might be helpful for stimulating some action in the VC space. Does this affect your book, number one? And number two is, if not this, where else is your team looking at now?
For us, AI is interesting because, of course, we all got left behind by the Magnificent Seven, who rode away with returns from March until now, which were extraordinary. The markets priced 7 or so companies and gave them an extremely high multiple for what they believe would be they're capturing the biggest share of AI, which of course you and I know through living through .com and everything else is not going to be the case. That it will be spread, and the pyramid of proliferation will exist on any new technology. And so we think everybody will benefit if this truly is, and that should come out, as an example. And to use a household name, Apple trading at 28 times the forward earnings when it grows 8% and it's got nowhere to reinvest its money is probably high, given its average is about 18, but that's where investors went. And maybe it was for safety, maybe it was for AI. So we're treating AI as if it's a real technology, it will benefit many. And we can't be predictors there. And that's really not what we do best. But we do think the bloom is coming off that rose somewhat. And we are seeing those premiums wane. Stocks are starting to cheapen up, especially in sectors that were sort of hit on the periphery of it. And that is creating opportunities. Software is one of the best areas that you can roll up because there are so many different niches to software. And for us, that's a real opportunity. And we're focusing there right now. When you think of it, there's communication software and there's cloud software, and all of these legacy businesses make it very, very good and total addressable market in these businesses. So you could have thousands of companies in just the cloud service software market, which is an interesting market because cloud is now 12 or 13 years old. So it really falls into our area. Oh, we can have 10-year track records on some of these players. And there are CEOs who are opening up a second vertical saying that is a great place to be. There's thousands of these legacy software businesses around. They're growing organically at 3 to 5%, which is okay, but I can acquire them and acquire those nice steady cash flows that they've been earning and take that as well. So software is one area. Real estate's been under pressure somewhat, and we don't want to get into the real estate business, but we really think there are good real estate service companies. And again, from the acquisition standpoint, we invested in a company called Colliers, and they are a real estate servicer and broker and asset manager. So all of these things.
That's interesting because we've been hearing doom and gloom, especially in the commercial real estate sector, for the better part of the last 18 months. But Scott, you're telling me that the team is excited about going knee deep into this space. Are you talking about Colliers as an operator? So are we looking primarily at asset light type of firms or?
Absolutely. Yeah. We really want to be in that picture where they continue to be acquirers. So they're buying small servicers around the country, around the world that are servicing anywhere from residential to commercial properties. They're acquiring small brokerages that are facilitating transactions, whether they're going to be commercial or residential. And all of this is good because you don't actually own the assets. You're just owning all the noise that goes on between all the assets. And that has an agency fee attached to it. And that fee has always been pretty good. You need someone to shuffle around all of that, or you need someone to clean the buildings. And that's what these businesses specialize in. And they haven't been cheap like real estate. They have traded at somewhat of a premium. Another company that just specializes in HVAC, and they roll up all the HVAC players through North America. That's a wonderful business we'd love to own, but they have been trading at a premium despite real estate coming off. So it's not as doom and gloom out there on the service side as it is on the asset side.
So we talked a little bit about property services. I'm starting to get a sense of where your team is tilting towards. Key, of course, is still maintaining that fiscal discipline, but at the same time, taking advantage of, especially this high interest rate environment, a lot of good deals. Even if you look at JP Morgan, which is looking at devouring all of the regional banks, and perhaps in phase 2, they'll devour even more. There's a lot of M&A to be had over the next 18 months as things rock out. The last time we spoke, we actually were concerned about a shakeout in the market. We were looking at, I think it was just before audit period. And now we're thinking, there's got to be some type of scandal or collapse to come down the lanes. The regional banks did end up capitulating and needed to get backed by FDIC. Is that the end of it in your mind, or do we still have some ways to go? Because this could instruct the next 6 to 12 months of how you're allocating capital to your managers.
Regional banks are interesting, and the M&A that you talk about is going to be active over the next little while. I think what we learned from SVB, you and I have talked about, is that for the first time, the banks really experienced real-time deposit movement. And that had never been the case before. The case for the regional bank was that you could go down to your local bank, the manager knew you, it was easier to get the loans, and that all disappeared because now I can move my deposit from one bank to another on a click. And that makes the deposit base and the purpose of a regional bank a lot less compelling. And I can see some of the bigger banks, and I could see some of the regulators and authorities in the US allowing the regular banks to start moving them because it does lower the risk. Just the speed of deposit movement, I think, presents somewhat of a problem in that area. If they can find a way to get their customers sticky again, Remember, it used to be so hard to move your bank account. You would never do it. I mean, it would just be such a pain. The pain to move a bank account would be so much. I'll just leave it. I'll take it.
We're not the types to line up in front of the bank. We see those images of people lining up in front of the bank, but I think if something were to happen to my bank, just like you said, I'd get online, start clicking away, and hopefully they don't drop the gate before I get the cash out.
Yeah. And now if you're a regional bank or a medium-sized bank and you need to find a reason, how can I make my customers sticky again? What service can I provide for them? So unless they find that, you're going to see them start getting absorbed in bigger banks. I think people will think there's 6,000 banks in the US. If they cut that in half, it wouldn't be a big deal. But the regional banking model is one thing. We talked about the shakeout in funding and financing. That is still down the road, in our opinion. I think you and I might have been a little bit early on it when we were talking about seeing that it's going to happen. But as is the case, we get to speak to a lot of CEOs, and not just in our businesses, but in other businesses. And those that needed to refinance were really taking their time, believing that interest rates might peak and come back down. That uncertainty about interest rates that we've seen through the markets also existed in the treasury departments of many companies. And do we refinance now? How do we do it? How should we do it? As interest rates settle down and they know that they're not going back down to 2.5 or 3, and that this is where you're going to have to raise money, I think this is when you're going to see the problem. And so where you and I were thinking it might be post audit season, it still might be just after in the new year, but it's inevitable to happen. I think the delay was people perhaps hoping that interest rates would not go as high or come back down again. But that belief in the information that we're getting is slowly dissipating, and you're going to start seeing the refinancing happening higher, which is going to cause some issues.